Okay, so now we have the 2-3 work together. Some more practice with those T charts and transactions. So I'll just start right in here. So March 11th, sold services on account to Johannes Eriksson for $125. Mixing in some new account titles. So our two accounts that are going to be affected. So that's sold services. Now we have, instead of just a capital or owner's equity account, we actually have a sales account here on our accounts titles list. So we're going to use sales. And then we've got an account title for accounts receivable, Johannes Eriksson. We'll click our drop-down menu. So sold services on account. So accounts receivable. When you sell services on account, that's money that needs to be paid to the business. So that's money that needs to be received. So that word association there, money that needs to be received. Accounts receivable. And those AR accounts are an asset. So $125 there. And then the other account, sales. And if you're looking at the paper copy of the book or the ebook, sales falls under that owner's equity group. So an increase in sales goes on the right side or on the credit side. So March 13th, received cash from sales, $260. So cash, received cash. So it's an increase in an asset on the left side. Another sale, just like the other sale, any increases in sales goes on the credit side, $260. And the next transaction for the 14th, paid cash for telephone bill. So if you look at account titles, there's no telephone bill on here, but telephone bill is going to fall under that utilities expense title. That's a utility. So that'll be counted as utilities expense. So we've got our two accounts, cash and utilities expense. So here's utilities expense. So that's going to go on the left side on debit because that decreases owner's equity. So it falls under that utilities expenses. The expenses fall under that owner's equity umbrella. So this decreases it. So that's why that goes on the debit side. And we have cash. Cash decreased because that was paid out for the phone bill, $50, $54. Okay, so now we're up to the 16th, received cash on account from Johannes Eriksson. So received cash, so that account's receivable. cash. Received cash. Cash goes up. So it's an increase in cash. That's on the left side. Then an accounts receivable. So now the amount that Johans owes is decreasing by $125 because they're paying towards their bill. They're paying all of their bill, but they're paying it, so it's going to decrease in the amount that he owes. So 125 on the credit side. There's accounts receivable as an asset. So any decrease in asset goes on the credit side. And then our last transaction, paid cash to owner for withdrawal of equity, $200. So took money out, took cash out, so cash account, and the owner withdrew money, so that's going to be the owner drawing account. So the owner's drawing account. So when the owner takes out cash, once you break those umbrella titles down, so that owner's equity, a lot of things can kind of fit underneath that. The capital account and the drawing account fit under that umbrella of owner's equity, just like expenses do. So when the owner withdraws cash, that's called a drawing account. So the money that that John took out of the business decreases the value of the business. So that decrease goes on the debit side. And John took out cash, so cash went down, so that decrease in cash goes on the credit side. So there is the 2-3 work together.